Hello everyone, the CPI data was out last week and inflation is still red hot. But the stock market seemed to take it quite well as we did not have a big sell-off. In this video, I will share my views on what can we expect after one of the biggest landmines has been cleared and what other obstacles are ahead of us. First up, a quick market recap. The major indices finished last week with slim to modest losses, but it wasn't a quiet week. The stock market got off with a bad start as the major indices kept sliding. It then ended Friday's trading session with a sharp rally, largely thanks to a stronger than expected retail sales data. Major bank stocks also rallied hard after Citigroup reported higher than expected earnings on Friday, totally ignoring the disappointing results by JP Morgan, Morgan Stanley, and Wells Fargo. Speaking of ignoring poor results and bad news, surprisingly, the market only had a little sell-off when the CPI data was announced on 13 July. In fact, the market seemed to be unfazed by the high inflation rate of 9.1%. To be very frank with you guys, I was expecting a fiercer sell-off with such red-hot inflation report. But at the same time, I was also skeptical about how easy would that be for bears and put buyers, a view that I have posted on Moomoo. And guess what? Put buyers who entered the market on the day when CPI data was released are likely in the red now as the market rallied hard on Friday. Well, if there is one takeaway from this, it would be never be too biased towards bullish or bearish stance, as the market tends to do the opposite of what the majority thinks, and it likes to spring surprises for investors and traders. So, when the market did not sweat over bad CPI data, does it mean we had hit the bottom already? Well, my view is still the same, and that is, we are not out of the woods yet. I also urge traders and investors to remain vigilant. The upcoming potential landmines or key events are definitely the earnings reports of the top US companies, followed by FOMC meeting on 26 and 27 July. Personally, I feel earnings could be a big catalyst and main driver for the stock market in the next 2 to 3 weeks. The performance and guidance from the major companies can likely offer a much broader picture in terms of future earnings and the economy. Okay, for the immediate upcoming week, I will be paying close attention to Netflix and Tesla's earnings, which are scheduled for 19 July and 20 July respectively. You can also throw in Twitter earnings report. Alright, before I move on to the technical analysis portion, if you do find value in this video, I really hope you can help me grow this channel by clicking on the like and subscribe buttons. Thank you. Okay, let's have a look at SPY. Interestingly, SPY has been range bound for about a month since 21 June when it gapped up. It is currently trading between the two gaps as shown on the chart. On the upside, the gap is 394 to 399, which acts as a resistance. SPY needs to fill this gap and break above 400 to unlock more upside, which may go as high as 415, where the next resistance is. On the downside, the gap is around 369 to 370, which acts as a support. Other key levels to note would be the 50 moving average, which is around 392. It has been a while since SPY closed above it. So if it can do it in the next 1 to 2 weeks, then bulls will likely push it towards the gap at the top. On the other hand, the next level to watch on the downside is around 367, where the lower Bollinger Band is. If this is breached, it is quite likely for us to retest the recent low of 362. Moving on to Apple, but before we look at the chart, I thought I should highlight something, and that is, check out the volume ratio between the call and put options. The calls put seems to be very heavy at the moment. Does this mean that the stock will fall soon as the market makers aim to wipe out these call premiums? I'm not sure, as I'm not here to make any prediction. I mean, I can't speak for the rest, but if I am holding a call option, I would be quite cautious. And for viewers who are not aware, investors who buy call options are hoping for the price to go up. So in this case, it seems like a lot of investors are expecting Apple to go up. But is it that simple? I'm not sure. Okay, looking at the chart, Apple looks bullish since it gapped down twice on 10 and 13 June as it embarked on a small bull run. It even closed above the 50 moving average at around 144. So will this bull run continue? To be frank, I'm not very sure. In fact, I am skeptical. As the stock moves towards the upper Bollinger Band at around 152, I am expecting some form of rejection. But this does not mean that the stock will plunge down, okay? Keep a lookout for 144 as the 50 moving average is acting as a support now. Other key support levels at the bottom are 140, 137 and that little gap at 133. On the upside, we have a major resistance at 158 where the 200 moving average currently sits at. Personally, I am waiting for some weakness in the stock so that I can sell some put options. Next, Tesla. I find this chart rather interesting at the moment. To me, it appears that there is this giant bear flag forming, marked by the white lines, which I could be very wrong on this. But say, if this is indeed a bear flag, I think things can turn ugly in weeks or months to come, and we may fall to 600s again, or even hit the 500s range. Anyway, there is also this descending triangle on the chart, which I have shared on Mumu and in my previous video. Look at how the stock respected the descending triangle by testing the top of the trend line on 3 occasions, and it got rejected each and every time. I'm just gonna pull out Nvidia's chart again, where a bearish descending triangle was spotted. And guess what? The stock broke downwards and created a 52-week low. But will this happen to Tesla? We don't know. So watch carefully how the candlesticks form within the triangle in the upcoming weeks, and look for a potential breakout. Okay, in terms of resistance levels, the immediate one would be where the current 50 moving average is at around 722. This will be followed by a level that I have been talking about for weeks or maybe even months, and that is 746. It seems like the market is giving a lot of respect for this Fibonacci retracement level as it got rejected on multiple occasions as marked by the red circles. Okay, a quick one on Nvidia. I decided to cover it this week because Nancy Pelosi's husband just invested millions into the stock before a subsidy bill. I'm not gonna elaborate much on that as you can do a Google search to find out more. Anyway, looking at the chart, if the stock's gonna fly, keep an eye on 170 where the 50 moving average is, followed by the gap between 176 to 180. And to note, 180 is a huge resistance level in my opinion. I feel there could be some form of rejection around this range if the broader market decides to have another leg down. On the downside, you have 150 as the support, and of course the newly created 52-week low of 140. Personally, I'm looking at entering at this level around 140. Okay, here are my end thoughts. All in all, earnings season is amongst us, and the earnings news can literally set the tone for the entire stock market in the coming weeks. This also means that there will be lots of opportunities leading up to and post earnings, especially for option traders as the implied volatility tends to be high around this period. But one has to be really careful to play with these earnings reports. As shared earlier, don't be too biased towards bearish or bullish. For instance, do not have the mindset that the market will plunge with poor earnings, because analysts have been discounting second quarter's figures as they are expecting the numbers to contain disappointments and downward revisions, because companies are dealing with inflation, supply chain issues, staff shortages, and now a slower economy. Who knows, the expectations could be so low that the companies could easily beat them, right? So does this mean that the market will fly? Not necessarily. Despite the lower expectations, I wouldn't be surprised that any sign of weakness in a leading company will likely cause a ripple effect within the same industry. As I have always shared, let the market makers go first and watch out for key support and resistance levels. Once major support levels are breached, then yes, the market is likely to be bearish. And vice versa, if key resistance levels at the top are broken, then it is likely bullish. In other words, don't try to predict the market, let the charts and technicals show you the direction. Anyway, I know some investors or traders love to ask this question. Will the market go up or down next week, or will this stock be red or green by X date? To be frank, nobody can accurately predict the outcome consistently. Therefore, it is important to watch how the charts move. Case in point, I highlighted two key levels 137 and 140 for Apple stock some time ago. And once Apple broke above these two levels, I mentioned that there would be upside. And guess where Apple is right now? It's $150. And that is what I meant by letting the market makers go first and watch out for key resistance and support levels. Alright, with that, I hope you have learned something, and that's all for this video. If you have found some value in this video, I really hope you can hit the like and subscribe buttons. They mean a lot to me and will keep me going. Thank you.